overview of the budget. So may I request all to take their seats and please put up an alarm outside. So again, namaskar, a warm welcome for the pleasant morning and the perfect venue, I believe. And as I enjoyed, I believe that everyone enjoyed the good paratha, snacks, idli, dosa, and many other varieties of the Taj food. Today, the session is very focused. As we saw recently, budget is all dedicated towards agriculture, infrastructure, MSME, hundreds of amendments in taxation, and then ultimately the tax reliefs as well as the tax increases. And that's where sometimes I've quoted a balance sheet budget, and media picked it very quickly. And I'm happy to share that on Akashvani, Prasar Bharati, DD News, many of the Press Trust of India News and then NDTV, etc., they all quoted me as balance sheet budget. So here, we are not only at balance sheet, but with the profit and loss statement of affairs. Today, we are blessed with seasoned tax experts. I'm not going to introduce now because my another colleague, the convener of Triple AAA Focus Group, Mr. James Matthew, who himself is an introduction for the industry, and I will request him to come on podium and take the session forward. Mr. James Matthew.
Good morning, everyone. Thank you for all of you for joining this today. This is a change of venue for first time, I guess. I think normally we are used to the Taj Business Bay, but welcome all of you to Taj JLT as well. Extremely pleased to see a lot of our friends of IBPC here today, and special welcome to our board of governors, Jayashree, Ramesh Mahalingam, and our eminent panelist speakers, Mr. T.P. Oswal and Nikhil from HSBC. Mr. T.P. Oswal, I think we had, I think more than 2 occasions, we had the opportunity to host you in the Institute of Chartered Accountants of Dubai chapter, which has got around 3,400 plus chartered accountants as members. Venkatesh's time when he was the chairman, I was vice chairman there. Ramesh Makwana's time when he was the chairman, we had the opportunity to listen to you. Transfer pricing expert, I'm sure, I think all of you will have, more, I think the lion's share of litigations, tax litigations revolving around transfer pricing, I guess. So I think you are a veteran, and I'm sure the community will learn a lot from you. Last night, we attended another session of a tax session where one of the eminent speakers, S.P. Renina, who spoke about Shining India. And he spoke about 200 million of middle class people. He talked about 45% of the people are less than 30 years of age. Global capability centers from multinationals coming to India. So they are all looking for resources, and India is doing well. I'm reminded of during my time when Mohandas Pai came, and he did a session a few years back, and he was talking about the same thing. And it was so overwhelming that many of the people said, I think it's time to go back to India. And then I remembered the secretary at that time said, those of you who want to go back, please go, but then pay the fees and go, pay the membership fees for that. So that was the time. Anyway, I just wanted maybe before I introduce the first speaker, a couple of things I just wanted to just talk about the infrastructure. I moved out from India, from the southernmost state of India, which is Kerala, 33 years back. And last 6 months, of course, I've been traveling to Kerala and looking at the infrastructure. You say, for example, Vande Bharat. I had the opportunity to travel a couple of times. And I think it's matching world class. You've traveled across the world, you find Switzerland, any of those train. This is amazingly done, timing wise, and by the way, Vande Bharat, Kasargod, that's in Kerala, Kasargod to Trivandrum, is the most profitable Vande Bharat. This is what is being told. So 183%, that's what they say occupancy, because I think people get down in between and go. So that's one thing. Second thing is the road infrastructure. Kerala is a very densely populated state, which is, land bank is not available. But now if you go, you will find a 6-lane road, and which is fully lit with lights across on the road, traffic lights. I mean, the lights across. So I think the way the infrastructure that's been built over the last 10 years, it is really, really amazing to see. It is really remarkable, I would say. So I would just pause here, and really looking forward to India, and just to the interest of the panelists and who have come from India. People who lived here for maybe 5 years, they, after, even if they retire, they would like to go back at some point in time, but they may take a decision to go back, but after 6 months they invariably come back. So it is the situation. So how much ever people tell us, okay, India is shining, India is doing, we may invest, but then and we jokingly say, the Sheikh Mohammed here, Highness, makes the life easy for people. So he wants people to, it's like a bottle. You get inside, to come out is very difficult, So you get inside, and then, so this is how all of us have been, I wouldn't call it spoiled, but then we are all enjoying the luxury. So I just want to introduce our first speaker, Mr. T.P. Oswal. Vienna is a very close and one of my favorite cities, and then I know that you are teaching there for LLM, I mean all the as an international faculty for tax, and you authored so many books, and of course you've come and spoken to all the communities here. I'm sure many a times you have come here, and just wanted to say he has got a 43 years of practice as a TP expert, and his TP initial, I initially thought it is transfer pricing, but it is not transfer pricing, okay? I googled up, it is Tilak Chand, something is there. So by God has given him that name also, TP. TP stands for transfer pricing, those of you who do not know. So that is it, and then he has written many books on international taxation, transfer pricing, black money law in India. So just want to, he's been part of the TP Regulation Committee since 2000, in India in 2001, and he's also been part of the subcommittee in the UN for the transfer pricing. So ladies and gentlemen, I would not want to waste any of my time here. I would want him to come and speak. Thank you so much, Mr. Oswal, please.
Good morning, ladies and gentlemen. Thank you very much for inviting me to UAE, third occasion. It's a good experience always. And all of you came to Dubai and settled down virtually. As rightly said by my first speaker, Mr. Matthew, saying that the attraction Mohammed Sheikh has created, that you can't leave the country. Narendra Modi is trying to create similar type of attraction. But let me tell you, we are a very large country. You are a very small country. And therefore, a population of 144 crore, to make them develop fully takes time, of which 70% are agriculturists, not paying a single rupee tax. And on the top of it, whatever tax is collected by the government is given by way of a subsidy, incentives, power free, and water free, and what sort of free, and minimum support price for their produce which they produce. So therefore, you can imagine the taxpayer pays the money, and how many taxpayers India has. You know, we have 9 crore taxpayers. If I speak crore is okay for you. We have 9 crore taxpayers. Of 9 crore taxpayers in India, 7.5 crore taxpayers file return without any income, zero tax, because it is mandatory to file the return. And at times it is useful to file the return. 7.5 crore pays no tax. Around 2 crore pay tax less than 50 lakhs, or less than 50 lakhs is too exaggerated figure, less than 10 lakhs. Paying tax of 10 lakhs means almost income more than 40 lakhs, 40 to 50 lakhs. And genuinely only 10 lakh taxpayers pay tax, only 10 lakhs, out of which 1 lakh taxpayers only contribute 99% tax of the country. Can you believe that? That is only 1 lakh taxpayer. And therefore, the ratio is so skewed that you can imagine how the taxes are collected. And there is no possibility for any government, whether it is Narendra Modi or otherwise, to recover tax from agriculturists. It is a vote bank. They will lose the election and they will be thrown out. So therefore, nobody ventures, and that is the reason why the only solution seems to be increase GST. If you increase GST, automatically everybody will pay. There is no choice. Agriculturists also will have to pay the tax. So there is no contribution of agriculturists cannot be said. There is a contribution, but by way of an indirect tax, which is regressive, not progressive. Further, on the top of it, what Mr. Matthews said about the infrastructure, this government's thrust is purely on infrastructure, and you can see the budgetary allocation. Last year it was 11 lakh crore, of which we have spent only 10 lakh 80,000 crore, and this year again we have targeted 11.2 lakh crore plus 1 lakh 50,000 crore for the states, which we are giving by way of subsidies to them, so that they can spend the money on their infrastructure. So it is virtually 11.5 lakh crore. So 11 lakh and 70,000 crore, or rather I would say 12 lakh and 70,000 crore, quite sizable. And one minister relentlessly working on this is this Gadkari. He has been, and if you create good speed to the country, speed to the economy, and that can be done only through infrastructure. If you have a good infrastructure, you have a speed on the road, you have a speed in economy, and country progresses faster. Look at Dubai. Can you drive here at a speed of 40? No. On Sheikh Zayed Road, you have to drive at least 100 kilometers. There has to be some norm. You know, once I came from USA and my driver was caught by police saying that you were speeding. Stop. I said, I was sitting, just that day only I came from USA, and I said, was he speeding? He said, yes. Where is the board that there is a speed limit? 1 kilometer behind. You are speeding, and we could see in a camera. I said, what is the board writes? Speed limit, 70 kilometers. I said, is it a maximum or a minimum? If it is a maximum, you should display it. In USA, it is a minimum speed limit. So therefore, it depends upon how do you interpret. He said, are you a lawyer? Please go. He let me go. There is no chance for him to penalize me. So this is what happens, and exactly the Kerala, what he says, I have traveled Kerala, there were only 2-lane roads, one way going, one way coming. But now if you are saying 6-lane road, fantastic, fabulous Kerala's development, I would say. I have not visited after a long time. And rightly you said about the Vande Bharat train. Now India is connected with all major cities through a Vande Bharat, one of the best trains. That was the only way you increase your railway fare. No other way. Because if the railway fares are so low in the world, anywhere in the world you could not travel in the railway in that much fare. Whereas if you want to increase the fare, improve the facility.
If you improve the facility, people don't mind paying. This is the best example. We will have a bullet train within a year or so. On that bullet train, though probably we may not run all the bullet trains on the same track immediately, but by the time track is ready, bullet trains, coaches are coming from Japan, we will create our Vande Bharat trains with 280 kilometer speed. Bullet is contemplated to have 320 kilometer, but we will per hour, and our Vande Bharat will give you 280 kilometers. Now you can imagine, we called Japanese to give presentation of bullet train. We called Spanish to give presentation on bullet train. But our intelligent engineers understood what the concept is, and they developed themselves the concept. And that's India, and that was the vision of Mr. Modi. Despite the fact that Modi was trying to do this, other parties, opposition parties were objecting, why do we need bullet trains? We need a lot of poverty removal. But please don't understand, you can't remove poverty without proper payment to the people. And proper payment can happen only if you progress. And if you progress, then only you have money surplus, you can pay the people money. Today I feel pity having been paying huge taxes, because all our money is collected by way of a taxes is frittered by way of Ladki Bahin scheme, yeah, so many other schemes, 10,000 rupees. Today workers are not available in the city because from the villages they don't like to come to cities because they enjoy freebies at home, free food given by the central government, freebies given by state government, allowances are given. So the workers have no incentive to come to, and this has happened in number of countries earlier. And we are going through the same phase. But anyway, it's a time will tell, automatically things will change. Next generation who is getting educated, they don't want to fall in this line, and therefore that will create a change. It takes some time, but it will take some change. For example, Bombay was one city which was developed as compared to other cities first. Now, we feel this is not developed, still not developed. And the second phase of development has started now. Bombay has started redevelopment of old buildings. Redevelopment of the old building means the real development starts. And if all the buildings are developed, all the cities get automatically developed. Well, friends, in this budget of this year's Nirmala Sitharaman, a good surprise budget. Good surprise budget, I say, because it is not a negative budget. All along, we have been, for last 46 years, I have been seeing the budgets. We were expecting in initial period of, say, 70s to 80s, people used to hoard consumables, consumer goods, soap, toothpaste, and also oil, all sort of things, thinking that tomorrow or midnight the rate will go up. Gone are those days. Thereafter, the stability came. But after the stability, increase in the rate of taxes went on going up, is going on. Every year you get surprises in the budget. There are some tensions created. Most of the time, the intention of the government is to create to catch hold of loopholes created by taxpayers and approved by the Supreme Court, approved by High Court, and sometimes approved by the tribunal. Now this time, I don't see any except one amendment, which is because of the Supreme Court decision in the case of indirect tax. Otherwise, there is no reversal of major decisions of the any courts in the decision. This budget, by and large, is intended to give relief to the people. I haven't come across any major change except one or two small, where of course they are required to be, if there is an abuse of law, one has to take care of that. Otherwise, you find it is beneficial budget, and therefore, in my opinion, giving 1 lakh crore incentives to the taxpayer, middle class taxpayer, is going to propel the economy. 1 lakh crore incentives given to the taxpayers, which I said to you, taxpayer means the person who pays the taxes beyond 7.5 crore. They only pay the tax. The person who pays zero tax doesn't matter whether you give 1 lakh crore or 10 lakh crore. But a person who is paying taxes beyond 7.5 crore people will get 1 lakh crore benefit. It has never been heard of in the history of India. Never. Now, this 1 lakh crore tax relief granted to the people is going to percolate to all the taxpayers. Maximum will be 1,10,000 per person. Does not matter. At least you have not taken money, you have given the money. And therefore, in my personal opinion, from that perspective, definitely it is a path-breaking budget, and it is a growth-oriented budget, consumption-oriented budget, because money going in the hands of the middle-class people will be either consumed, spending will increase, or it will go by repayment of their loans or consumable durables, or some savings which will also ultimately benefit the government. So therefore, economic dynamics evolve from globalization and multilateral cooperation towards unilateralism. World over, the thing is, you can see the Trump's announcements. There is nothing, I don't want to be part of Power Pact. I don't want to be part of WHO. I don't want to be part of this, that. And every day you get new announcements, excellent announcements. And that has created ripples world over. And that is going on. And therefore, hopefully, our Prime Minister is going to be in Washington on 13th. Hopefully, this will not be adverse to India. We have good relations with Trump, and we will take out something from him rather than be disappointed with his meeting. In this budget, if you look at our fiscal deficit is 4.8%, which had swelled up to 6%, 7% in the past, in last few years, in COVID period also. Now, next year it is planned at 4.5%. 4.5% fiscal deficit, and the government has a desire to bring it down to 3.9%, which used to be. And 3.9% fiscal deficit, some fiscal deficit is essential because that can bring some inflation and that helps the people. It is not the case that a fiscal deficit is disadvantageous. Its economic indicator suggests fiscal deficit is going to be major beneficiary. Oh, I'm sorry. I am changing my slides. Anyway, these slides are distributed to the organization. If they want to distribute amongst the members, most welcome. I have no problem. They are general in the nature, and therefore I don't keep any copyrights in it. So the important thing which we have to see, what is coming in the draft new place tomorrow in the parliament on the direct tax code we call, or in Hindi they call Aikar Adhiniyam, new code is getting replaced tomorrow, and Hindi Karan is going on, and therefore new name may come in the Hindi. What is the government's desire, which has been spelt out by the minister and by the revenue secretary, that we will make law simple. We have 600 lakhs words in this present act, which will reduce to 300,000 words, 3 lakh words, and therefore it will reduce the half the size. If this is the way one has to understand, it is very easy. But what you are deleting and what you are retaining is an important thing one has to see in the blueprints, in the black prints, and that has to be seen. One thing which is, I am getting so many questions from UAE, is some Times of India digital version circulated that there are major changes coming in the NRI in the budget. That was in context of the budget, but there is nothing in the budget as far as NRI's taxation is concerned. But they say there are some changes are coming, and I am hearing only that one change possibly will come is non-resident's definition. Today you have a definition of non-resident under section 6 61 saying that if you are out of India for more than 182 days and you are employed there, you are non-resident. But then further subsequently the conditions added, if you are in India for more than 120 days and income is more than 15 lakhs, then you are resident, but in most cases you will be that resident but not ordinary resident. This concept of not ordinary resident exists only in India. It doesn't exist in many countries. So let us see what will happen. And here is the case where there has to be a voice coming from non-resident community world over. We in Indian can make noise, but it is not heard of. The associations like yours, if they make a noise and tell the government, if the Prime Minister comes here and you people don't, you only welcome him, don't show your problems, then it is not going to be heard. So this is what I believe it is essential that you must convey right now, in case if the tomorrow bill comes in, that this is, and this is going to be detrimental to the non-resident community particularly. Earlier, people thought that amendment to that non-residents definition of section 15 lakhs income and 120 days rule was targeted for non-residents in UAE. I believe no, because UAE had created under the pressure of India the TRC rule for giving for India specific 183 days, for others 90 days, or for the domestic 90 days. In fact, had it been happening in India, we would have challenged it unconstitutional because it is a discriminatory. But you have in UAE, we can't comment upon the laws of this country because this country has its own way of governing the country tax system. And if you are 183 days rule applicable to you, you are a tax resident of Dubai or UAE, then you can take the treaty advantage, you can get the TRC and then take advantage of treaty provisions rather than domestic provision. You have domestic provisions which says 120 days plus 15 lakh rupees income. But if you have got a TRC, tax residency certificate, and then you say that I am governed by the India UAE tax treaty, domestic rule should not apply to me. It is possible for you to argue it out, and that is one benefit available to you. Well, another amendment which has been, another statement which has been made in economics survey as well as by the government, the intention of this government is to reduce the litigations and reduce the number of laws, reduce the criminalization of laws, and therefore number of provisions will be made in the various laws which penalizes the person by way of a prosecution will go down, will reduce, and therefore that is a good intention which has been explained. Another major change which has been suggested is that we want to sign bilateral investment treaties with the various countries. We had all the bilateral treaties, but we suspended them because on all the bilateral treaties, the foreign taxpayers used to claim the benefit of tax laws of India, which the amendment to the tax laws was not applicable to them, and India lost in 3 or 4 cases in international arbitration. The government suspended all the bilateral investment promotion agreements. Now they are revising without tax effect. They say we will sign the treaty, but we will not give you benefit of any tax law changes happening subsequent to signing of the bilateral investment protection agreement. And therefore, to summarize in nutshell, the budget, this budget has laid down economic foundation, better foundation than what it was earlier, and while charting the path towards more self-reliant, robust and inclusive future. And this is what the budget is. Now let us come to the budget finance bill proposals. Finance bill proposals I can summarize in only these 6 or 7, 10 to 12 heads. I will speak as much as you want, but I can speak extempore on all the items. One point, the rate of tax. Across the board, rate of tax on individuals have changed, because I said the benefit is gone to all the persons of rupees 1 lakh 1,10,000 or so. In some cases it is less or more. Today you will not, next year onward you will not pay tax if your income is up to 12 lakhs of rupees per annum. If you are in Dubai, for you 12 lakh of rupees is nothing, absolutely nothing. But in India, when I said to you, even the taxpayers are only 7.5 lakh payers who are filing no tax return, and all the 2.5 lakh, 1.5 crore taxpayers are only filing tax return with payment of taxes. You can imagine, out of 1.5 crore, number of people will going down, because earlier our exemption was 4 lakh, now it has been increased to 12 lakhs of rupees, and that applies across the board. Salaried class of employees are further added, 75,000 standard deduction has been granted to them. So therefore, for them 12 lakh 75,000 exemption. Further, the people who have paid National Savings Scheme or National Pension Scheme contributions, at the time of withdrawal it was liable to tax, and now government said that also will be exempted, and therefore that is around 50,000 rupees or 75,000 rupees per person, and therefore actually speaking the budgetary benefit is around 13 lakh 12,000 rupees per person. And in my opinion, from jumping from 4 lakh to 13 lakh is a major change in the country, which has never happened in the past history of our independence so far. And you will be surprised, you will say therefore, what does it imply? Does it mean that your tax collection goes down? Answer is no. Experience showed last few years, the government of India estimates the tax collection on account of personal taxation X, and they get X plus 20%. And every year this is happening for last 4 years. So government is expecting even this year they have projected a particular tax collection, but whereas the collections they are expecting it to be more than 2 lakh crore. So therefore they say this will be set off without any problem, and that is a major confidence the government has. And this year you will be surprised to know our tax collection on account from personal income tax has crossed the corporate tax collection. First time Indian income tax history shows corporate tax is always higher than personal income tax, whereas this year personal income tax is found to be higher than corporate write-off. Haji? I didn't get you. Good, everybody is paying contribution. Reason I'll tell you, I am coming to the reason. You will then come to know whether good or bad. You ask the question whether it is good or bad. Everybody knows India has parallel economy, correct? Parallel economy, all you understand, black money. And that economy is now getting converted into the white economy. The reasons are very simple. Why? Because of GST, because of digitization, because of cross verification and automatic verification which is taking place. When you file your tax return, you get the information about your high financial tax transactions automatically. Told by the income tax department, these are your transactions for the year which are high in value. They have defined high in value. And therefore, while filing the return, please take care. We are not telling you that you please disclose, you take care. It means that an opportunity for you. Now those people who are not regularly filing the return, not regularly reporting such transactions, they also get scared when their reported transaction comes in. So they report some income, and out of that they report this transaction. So one of the reasons. Second is TDS. India is a country, in the world I have not come across any country which believes in collecting taxes by way of a tax deduction at source, withholding tax which we call internationally. And that withholding tax collection is almost 50 to 60% of the total tax collected during the year, apart from advance tax. So therefore, when withholding tax comes to the government, and that is where they can find out whether the recipient or payer or recipient of the income has paid the taxes or not. So one of the another reason. Third reason is on GST, high value transaction. People used to do a transaction with the retailers like Sabjiwala or vendors, small vendors through Google Pay. Google Pay is one concept which does not exist in your country, but we have Paytm, Google Pay, blah, blah, blah. So a small transaction, you don't have to carry money, just click it, you will get the money, the person gets the money, transaction is over. And at times I had a very interesting experience. I went to airport, I had some cash as well as my credit card and everything. So I told driver, I'm giving you cash. The transaction was 360 rupees. I said, I don't have change, get 500 rupees. He says, don't worry sir, you have Google? I said, I have, but I can't operate, I don't know how to operate. No problem. Honestly speaking, the technology is, for an older generation people is a problem, but younger generation people enjoy. So I said, I don't have. He said, doesn't matter. You have Google account? I said, yes. I am paying you remaining amount by Google. So he transferred the change to me by Google. I was so shocked and pleasant shocked. And so that's why you feel sometimes, yes, India is improved. And world over, you look at the total digital transactions, financial transactions in any country of any part of the world is highest in India. Because of our population is one reason. Yes. Friends, this is as far as general provisions are concerned. So across the rate, across the board, if the tax rates are going down, the government believes the tax collection will go up. You can imagine the tax going down and tax going up, how much difference it is the government is going to collect. And this is what economical growth, this is what the India's progress is. And you can see that India progressing by 2027-28, we will be third largest economy of the world. I believe earlier projection was 27, but now they are all saying, some economists are saying 28, but certainly it will happen. It is not far off. When India, you people are proud that India has become third largest economy of the world. But now let me take the provisions of income tax as many details as possible. First item is harmonization of significant economic presence. This was a problem which was created by OECD. China and India was demanding that when your goods are being sold in our country, you make a profit. Profit is made by you not because you manufacture the goods, but because you sell also the goods. And therefore some profit of that sale of goods must attribute to us, and you pay tax on that. And that demand led to both India and China, consumption story. That demand led to OECD to think out some solution. They created BEPS Action Plan 1 to 15. First action plan was digital economy taxation, and that never took off. As of today also, it started in 2014, but never took off. Reason being very simple, USA never agreed. Who are you taxing? You are taxing American companies. Americans are all supplier and you are all importing. Developing countries are all importing. No other developing country has such a big voice as India and China is, because of our purchasing power, because of our population, and because of our huge market. Once upon a time, our population in India was a liability, but today it is an asset, because everybody thinks that this is a market, where should the business be done? So American opposition on that digital economy taxation became very severe. So OECD suggested, we give you three alternatives. One, either you have significant economic presence, whereby if a person from foreign country do business with your country without physical presence, but his economic presence exists. So based on economic presence, you tax that transaction. Rules were created. Second option, equalization levy. If you are importing something by way of a technology, then they extend it to other items also. Then when the payer is making payment to non-resident, levy some equalization levy, which was done in 16 and 18. And third, when you make payment to non-resident, you withhold the tax. 3 options. Generally, they said every country is entitled to choose an option and decide the framework of law in their own country. Can you imagine? India believes in choosing all the 3. Our law created economic presence, our law created equalization levy, and also our law created withholding tax on non-resident payment. And that's the reason why it was very excessive. But we gave some exemption. We said significant economic presence will happen only in the case of countries who has no tax treaty with us. So we have 193 countries in the world. Almost 100 countries have a tax treaty with India. So therefore, there is no significant economic presence problem for them. But country like Bahrain, your neighbor, does not have tax treaty with us. So if anybody from Bahrain doing a business with India, there is a significant economic presence and therefore there will be a tax on it, and there are formulas created. Or payment going out of the country to anybody, equalization levy. This was to hit America because all the technology companies were from USA. And Trump knew this very well. When in the first term of the Trump, he last opposed this problem, opposed these principles of taxation. He says to the OECD, if you come out with such proposals, we will walk out of the OECD. Then OECD had no other choice than to defer it. So under some pretext or the other, they came out with a revised formula, this formula, that formula. Biden government agreed this proposal is acceptable to us. And therefore, OECD started after losing of Trump. And the OECD started working on these proposals. And they came out with a final formula, formal papers, BEPS Action 1, Action 2, Pillar 1, Pillar 2. I have not understood Pillar 2 as of today also, despite reading number of times. And therefore, I decided, I was confident that this will not come. And because I was again confident that Trump will come back and is going to oppose. First job he did after getting elected is oppose the Pillar 2 of OECD. He says, I will not support Pillar 2. US is not part of your pillars. And therefore, USA went out of it. Time is over? No, then let me not waste time on this. And because of that, significant economic presence subject has to that extent get diluted because the tax treaties are there. We have no permanent establishment. If there is no permanent establishment, your any type of transaction in India cannot be taxed, whether it is economically or otherwise. India has investment fund scheme and there are some hiccups under the alternative investment fund scheme. Alternative investment 1 and 2 had problem, 3 had no problem. It was a transparent entity concept. Business income was taxed at a higher rate in the hands of the AIF, and other incomes was taxed at the appropriate rate. The government had streamlined those changes by making it more simpler to the investor and in the alternative investment fund. Foreign portfolio investors. Now this is a major problem. Foreign portfolio investor FIIs, when they make an investment in India, they take the tax treaty advantage. And under the tax treaty, their investment held by them was, they consider it to be business asset. And if it is a business asset, the profits are taxable as a business profit. And business profits are taxable only if you have permanent establishment. If you have no permanent establishment, business profit is not taxable. So, and in some cases, even if suppose you take this as a capital asset, then some treaties, particularly Mauritius, Cyprus, Singapore, has a concept of Article 13.4 and 13.5 in the treaty with India. Article 13.4 says capital gain on sale of shares is taxable in the country of the situation where you are making a gain. There was grandfathering provision which was created by India. If your investments are made prior to 31st March 2017, those will never be taxed at all and therefore they are not taxable. Whereas now all the investments are taxable as capital gain. Now interestingly, Article 13(5) of the tax treaty says any asset other than Article 13(1) to 4 will be governed by Article 13(5). And Article 13(5) says the income arising on account of such investment will be taxable only in the country where the person is resident. So if the FIIs are resident of Mauritius, Singapore, Cyprus, only they have right of taxation, India does not have. For example, derivative instruments, there India cannot tax it. And that was the advantage. They tried to plug all the loophole, but still the treaty benefit will continue. And there is no change in the treaty benefit. What now they are trying to define is all the classification of your business income versus capital income has undergone a change. We say everything is capital asset and you will be long-term capital gain will be taxed at 12.5% and short-term capital gain will be taxed at 20%. India has streamlined last budget in July the capital gain taxation system. There are only two taxes, that is 12.5 and 20%. If it is a long-term, 12.5. If it is a short-term, 20% tax, any asset. And therefore, to that extent, these changes were made with a view to see what can be done. Virtual digital currency, VDA. VDA was a problem. The government tried to recover as much tax as possible. They tried to create as much most adversarial regime for taxation of digital currency. But because of that adversarial law in India, whole business got shifted to a country like yours. In Dubai is one of the major countries where digital cryptocurrency business is done. Result is government lost huge money, more than 2,500 crore rupees per annum. Now therefore, what now they are saying, still people are doing transaction by being in India on a platform in UAE. So now the obligation has been cast on the people who are running the platform, carrying on the digital virtual currency transaction, that they have to file necessary information report, who has done the transaction, what is the origin, etc., etc. So this is only information exchange report which has been sought by the income tax department in India. There are huge, you all know India has created International Financial Center, Services Center, IFSC, and that is in Gujarat, next to Ahmedabad city, Gandhinagar. Now this city was to promote maximum possible investment coming from world over and maximum possible funds getting shifted from Mauritius, Singapore, Cyprus to GIFT City. There were some hiccups. The government tried to, first of all, there was a sunset clause. It was applicable only up to 2025. But now the government said all such incentives will be available up to 31st March 2030. This time one change which I have seen in the budget, always in a large size country of our size, chicken-hearted mind of the government doesn't work. So therefore, what used to happen always, we used to extend the benefit for 1 year, 1 year, 1 year. Nobody can plan whether he should set up an industry or not based on 1 year's assurance. Why should he set up? This time, first time I am seeing, it is extended automatically for 5 years, most of the incentive provision. And therefore, this GIFT City incentives, there are almost 15 to 20 sections under which amendments have been made, basically to extend the date, nothing else. Except 2 or 3 amendments which are relevant, which is if you have got a shipping line carrying out leasing activity from GIFT City, if you have, last year we amended, if you have got airline business leasing activity to India carrying out from GIFT City business, GIFT City company, the lease rental payable by India to the GIFT City company was exempted, not liable to tax. And of course, then people from GIFT City, they would pay to Ireland and then it will go to the respective owner of the aircraft or company leasing the aircraft. And that used to give, that created a good advantage for a leasing business of airline business in India, airline leasing business in India. Despite the fact we say airline leasing business has become advantageous, I personally believe, we are the auditors of some of the airline companies, we know, I personally believe if the income tax department want to become nasty, they can always be. Because if you look at the Ireland-India tax treaty, we have special provision under the treaty that payment of lease rental for Ireland, lease rental paid to Irish company is not treated as a royalty. And if it is not treated as royalty, where is the question of taxation? Withholding tax is not applicable. But Indian tax authorities have invoked these provisions, ignored these provisions and taxed Indigo, AirAsia and so many other airlines. And the litigation is going on. And with a view to remove such litigation, government created this two-layer leasing structure through the GIFT City, and this is going to be beneficial. Excellent. Next is loss on amalgamation. This is one provision which is not in favor of the taxpayer. If you have company which has suffered losses, if your company suffered depreciation, depreciation carry forward is indefinite without any limit. But loss carry forward for set of purposes is only for 8 years. What people used to do, in 7th year, merge that loss making company into a profit making company. So their life of the loss begins from day 1 for 8 years. So therefore, government found that this is a loophole and they said no, loss of a company which is suffered will have a life of 8 years, whether it is prior to amalgamation or after amalgamation. So therefore, even after amalgamation, if your loss left will be of 1 year, it will be allowed to be set off only for 1 year, not more than that. So this is only to take care of Supreme Court decision, and also number of the government thought that this is not intended, so therefore they removed this provision. Presumptive taxation. The government has created some provisions which is on the basis of notional income, sorry, not notional, actual income. If you are carrying on business of goods, services or goods to a company manufacturing electronic goods in India and you are a non-resident, your profits will be taxed. That special provisions have been introduced, the profit will be taxed at 10%. Not profit, I am sorry, the gross receipts will be taxed only at 10%. My opinion, if you are taxing gross receipts at 10%, it means you are assuming profit has to be 25%, which is very high. But nevertheless, some representation will go, and let us hope that some rationalization will take place. Last 3 amendments, TDS and TCS, you people are not much concerned, but one change which I must explain, that we have TCS and TDS both. The TDS is tax deducted at source, TCS is tax collected at source. And in one particular transaction, if you are a high value trading transaction, more than 50 lakhs of rupees, there is a TDS as well as TCS. Government realized this difficulty after so many years, and they have removed TCS provision, and now TDS is only applicable. Rest of all, streamlining of TDS has been done. Indian government has increased the rate of withholding tax exemption limit. Minimum threshold limit has been increased, and therefore to a great extent beneficial. Particularly notable is rent. If you paying rent to a landlord, earlier that limit was 240,000, rent up to 240,000, the the tenant was not required to deduct tax. But now the limit has been increased to 6 lakhs rupees per annum, or rather I would say 50,000 rupees per month. The law says 50,000 per month. Effectively, it comes to same amount. Next item is transaction on transfer pricing. Transfer pricing, people introduced me as a TP Ostwal means transfer pricing Ostwal, which is not the case. Somebody said time pass Ostwal also. And believe me, because of my name, TP Ostwal, the persons who the direct tax committee on transfer pricing in India, they say you are fit person to come in. You can imagine, just on the basis of name, people are selected. We have major problems in the transfer pricing. We also measure problems in APA, Advanced Pricing Arrangement, and you are going to face those problems sooner than later in your country, because in your country also you have the draconian, most draconian income tax act I have seen ever is Income Tax of Dubai. Such a small law consists of so many, all complicated provisions of the world, all brought together, khichdi together under one statute. We introduced provisions gradually, time and again, as and when we found it necessary. You have got group taxation, you have got CFC, you have got so many other provisions, including transfer pricing. Singapore introduced transfer pricing, but they are not so serious about implementing. They say only IMF wants, OECD wants, we also have law. They believe very proudly that we have a law. How do they implement? Who's care? There is no problem. But I believe if UAE wants to be very seriously implementing like India does it, because here officers seems to be, half of them are Indians, and therefore no wonder Australia also has Indian officers. What hiccups are happening there, I can understand. So I would not be surprised if something that happens here. And transfer pricing assessments, we have a concept that the transfer pricing officer has to determine arm's length price. We have created the law. You can ask the officer to, in advance, decide arm's length price for 3 years, a period of 3 years. There are so many nuances which are going to be challenging, because they have to create rules. When you have to create an option, when you have not yet introduced the next year's return, before that you have to exercise the option, or when the return is taken up for scrutiny under the transfer pricing, all those amendments have been yet to come up in the rules, etc. And therefore this is one noble concept, 3 years assessment at a time, but in real life how it is going to take place, time is only going to tell us. And the last amendment I will take in other proposed amendment, there are so many, but one more important to be noted, we have time barring provisions of filing return. You file the return up to a particular date. If you have not filed, extension is available only up to 31st March. For example, a company is required to file the return up to 31st October or 30th November. If you have made a mistake, you can revise it up to 31st March. That's all, nothing else. And thereafter you can't cure your mistake. To cure your mistake, the Government of India 2 years before created a law called, section called as updated return. You can file your return of the earlier year by updating, by increasing your income and paying 20% of extra tax and penalty in the first year. In the second year, 50% extra tax and penalty. Now they have extended this to 4 years. Paying tax for third year 60% and paying for fourth year 70% tax and penalty. Well, in some cases it is quite beneficial. People like your country, all your incomes are official. There is nothing like official or unofficial. Whatever income you earn goes in your bank account. And out of that you buy properties, buy assets, buy assets in India everywhere. Somebody mentioned that people are hesitant to go to India because of this reason. If you go to India and become resident, you have to disclose your all foreign assets. A fear is in the mind of the people is whether my disclosure of foreign assets will be subject to scrutiny. Answer is yes, but you have nothing to worry in case if suppose the assets are acquired out of officially earned money. However, income tax return, while filing the return of income, has a requirement of disclosure of foreign assets under a separate schedule under the Schedule FA. And if you have forgotten to file that Schedule FA properly or you have not filled up this properly, penalty under the Black Money Act is 10 lakh rupees. And second penalty of under the Black Money Act is another 10 lakhs rupees. And therefore, with a view to avoid such penalties, you can take advantage of updated returns. Thank you very much for listening patiently. I have exceeded my time. And if you have any questions, I will take them.
Thank you so much, sir. In the interest of time, we will just move to the second speaker. We have 8,000 Indian chartered accountants, which is 2.5% of the total Indian CAs. In India, where 400,000 CAs are there, 8,000 CAs a year. Another 4,000 plus from ACCA, another maybe around 500 to 750 people would be from CPAs and sort of thing. You're talking about 12 to 14,000 people. So they will take care of it, sir. Thank you for the whatever on the tax laws, if there are some things there. So I think that's where the business is being run. The big fours are done from. I'm told that PwC and some of the big four firms have done it. They from Amsterdam, London. They have drafted this one, and you rightly said transfer pricing is a catch because so many of the businesses have been set up with related parties because there was no tax. People have set the business there, and I think that's an area where probably people will get caught. But then they have put some threshold of 200 million above sales and so many other things. So it's not going to be, as you said, not be that strict, at least for the few years. That's what we can get to hear from. Yeah. So thank you so much. And we have the second speaker, Nikhil. So Nikhil, you are sandwiched between all chartered accountants only. Yesterday you said you complained that you're one second, just yeah. So this is again chartered accountants. Nikhil is he's the managing director and head of international and forex HSBC India. He's an alumnus of IIM Ahmedabad. He is currently responsible for strategic execution and delivering HSBC Group international priorities. Prior to joining HSBC in 2015, he managed a team of private bankers at Chanchart. He relocated to India in 2010 after spearheading more than 5 years with Citibank in UK, managing offshore portfolios of private clients based in UK, Scotland, and Spain. He's an avid golfer and a fitness enthusiast, as you can already see that. So ladies and gentlemen, without much ado, I would request Mr. Nikhil to make a presentation. So he will speak for maybe around 15 minutes, and then we will have the question and answer session. Yeah. Please prepare your questions. So in case if you want to make the life easy, please send the questions so that we can finish it off faster. Thank you. Welcome, sir.
Good morning, ladies and gentlemen, and thank you, James. Thank you, Mr. Oswal. I think it was a very, very enriching presentation. You spoke with a lot of passion. I think the good part is the passion which comes out in the way you read out the story. No, I think James spoke about this being sandwiched between the CAs, and I'll repeat what I said yesterday. In my institute, in the institute days, we had students from BBA and CAs and engineers, and as one of the batch of engineers, the classic 3 idiots story where we did engineering in electronics and went for MBA at the institute. But there was a lot of classic progression of a lot of CAs who went into the institute as well. And we really faced the challenge because, at the end of the 2 years course program, we had 20 institute scholars, we call them, top 20, 12 were CAs. So, and now in the last 2 days, I've actually had an opportunity to deal with a lot of experts on the market. I mean, yesterday, of course, Mr. Ranina was there, Mr. Bhupati in a previous forum earlier, and today Mr. Oswal, and a room full of professional CAs who are running large franchises, businesses, etc. So I'm very guarded about what I speak. But in our little understanding as bankers, I'm happy to share some of what we experience on a day-to-day basis. But and more so not directly from a budget standpoint, but also in terms of what's our reading of the markets, in terms of the activities happening in the last 3 to 4 months. Lot of disruption in the market, but how do we read trends, and how does that translate into the India story? Now, I will also caveat this by saying that one of the panelists last time introduced saying we're very keen to know what to buy and how to solve for the bleeding portfolios. Unfortunately, I'm not the panacea for that. I wouldn't be here if I knew everything. But what we can talk about is, as people who try and study market trends carefully, How is it evolving? Before I get into that, I also want to tell you, I mean, I saw Gift City being mentioned by Sir very vocally. I think it's going to be a big delta creator. I will talk about from a bank's perspective how we visualizing this. Sir spoke about from a taxation perspective, but I think that's going to be a big story. You have a large corridor in DIFC, which has been a successful offshore center. Intent, of course, is to replicate that and maybe a counterweight to other offshore centers. With that, just quickly stepping back, we've all capital dominates every conversation, right? And we've all seen some fair amount of disruption in the last 3 to 4 months in our portfolios. A lot of it is not really driven by missteps that the India market may have taken. A lot of it is to do with the global trades and how the fund flows are happening. So I want to just step back and talk about a little bit of what's causing these disruptions. So 2 key themes, of course, and a lot of it is to do with what happened in the US or what was expected to happen. Broad expectations 5-6 months back was US was going to be headed for rate cuts. Fed was expected to cut rates rather sharply, and the market was factoring in close to about 6 to 7 bips. 6 to 7 consecutive rate cuts of 25 bips each, which basically meant that you were headed for a benign interest rate environment globally. That would have happened, but as we heard more and more of the Trump story of America first and tariffs, etc., the fear of importing inflation obviously started to creep in, because as you put in tariffs, you will, from your trade partners, you will end up importing inflation. The other big, as a consequence of that, what you saw is a very sharp movement in the dollar, right? I mean, basically, your treasury yields moved from 3.4%, US treasury yields moved from 3.4% to about 4.8%, almost 125 to 140 bips jump. That basically meant that the whole expectations of Fed rate cuts had actually reduced sharply downwards. What is the impact of that? The impact of that is very clearly, it will determine which way the fund flows are going to be for ETF funds, the hot money, etc., because it had to find its way back into the US. So classic risk off scenario becomes attractive in such states. But the whole story is very simple. Just iron out some of these transient trades and see through what's expected to happen. And that's where our view is essentially originating. We feel that there's huge tailwind for US. US is expected to do very well this year, which will attract a lot of growth capital. By the way, a lot of the growth capital is anyways originated by the US, but we expect it to be retained there. Our base case view, we're looking at S&P 500 to do close to about 15% corporate earnings growth, which is a very, very substantial uptake for a large global economy of the size of the US and in dollar terms, right? So in a way, you're talking about the first big theme, which is solid risk capital formation, which is expected to originate from the US. The second big theme around this is, and I'm not getting into the politics of it, I'm only looking at the economics part of it. The second big theme, we constant, you are NRIs, you feel possibly impacted about it, and sometimes the easy press starts to, mention this, the rupee, right? Rupees moved from 83.5 odd now to about 87.5. Quite obviously, any of you would be inclined to say, why should I take exposures in rupee, etc., etc. Fair question, fair answer, fair opinion, but very important for you to realize that it is not the rupee which is collapsing. It is not the intrinsic depreciation of the rupee, but the actual intrinsic appreciation of the dollar, which is the cause. How do you evaluate this mathematically? You look at a very important index called the dollar index, which is dollar against a basket of 14 currencies, which includes, by the way, developed currencies like the pound, the euro, etc., and also the emerging market basket of currencies. That index has moved because of this so-called Trump trade in the last 3, 4, 5 months from 101 to about 109, so causing close to about 8.5% kind of sharp appreciation of the dollar. Versus that, the rupee has moved, dollar rupee pair has moved from 83.5 odd to about 87.5 or thereabouts, or 88, let's say. That's close to about 5.5 to 6% rupee depreciation. What it then means is that dollar is appreciated much more, and thus rupee on a real effective exchange rate basis is still an appreciated currency, right? Ideally, and there's been a change of guard in the RBI as well. So first of all, rupee is not a hugely underperforming currency. That should be the first underlying message. Second, and more importantly, RBI is also possibly reimagining their stance. They are mandated to tame in inflation. Fortunately, inflation in India is less, but they are also looking to have a mandate to focus on growth. Now, India needs to be part of the supply chain ecosystem, manufacturing ecosystem. We're going to cover this later, which means it needs to be competitive on its export and thus competitive on the currency. Now, if rupee is showing a constant appreciation, it will hurt the exports, which is why the new RBI governor's stance that the bankers are reading from how do you read the stance is by the level of interventions RBI is doing to support the currency. The general feeling is that they're letting it, to the extent possible, free float and take its fair value, because that will keep it competitive, which would mean depreciation. So our general view is that we're expecting this to be closer to 88, partly also because you've seen the runway to 88 rather fast, but it will, I mean, dollar is expected to eventually find its fair value. At this pace, if US, by the way, is in a very big quandary. Trump says, I want to cut rates immediately. Fed may not find the data fully supportive to cut rates, because with a strong dollar, they are also, their exports are going to hurt in that sense. And the other big thing is the US is headed for very strong fiscal expansion. They will expand their deficit, they will spend on the economy, which is again expected to be inflationary in nature. Now, if you have a high inflation, your chances of rate cuts are low, but if you have a political mandate which is pushing you to cut rates, it's a quandary. So we have to watch out for how it's headed. But how does it impact the dollar rupee as a pair, and how is it expected to impact your rate cuts is important for you to understand from an India market perspective. Today on our interest rate parity theorem, basis that dollar and rupee are more or less at a, I mean, you don't have a runway to cut rates. If USD does not, Fed does not cut rates in dollars anymore, RBI will be very constrained not to be able to cut rates, because if they do, rupee will depreciate immediately very fast. Now, of course, I know yesterday the RBI cut rates by 25 bips. How much is the runway left to further do these deep cuts? We have to still watch out for. But my sense is, as we are progressing in a scenario where we're not very certain of the degree of Fed rate cuts, and rupee has already come to a level where you will be importing inflation, but you will be importing inflation only from US. From other European counterparts and Asian counterparts, not really, because they have also depreciated, right? So vis-a-vis them, you have not depreciated. So those are the moving parts we're going to be watching out very actively for. Other key markets, the good part of this, as risk capital formation happens, who are going to be the beneficiary countries, and iron out the next 2-3 months as well, right? Because you will keep hearing of noise. The trick in all these, and you run businesses, is there will be those very short-term cycles. You avoid the noise, look through the trend lines. The trend lines are very clearly going to be huge capital formation which will happen in the US, but it has to find its way into some markets. Which is that market? And Oswal sir spoke about the structural story of India, the Vande Bharat, etc. The infrastructure improvement is a reality. The capacity to absorb capital in these projects is also a very big reality. You can continue to pump in huge monies and still be viable as businesses. And I'll talk about it a little bit in my couple of slides on the structural story. But the principal belief is that India will also be a disproportionate beneficiary of this risk capital over a sustained long-term period. Singapore, Japan, again, I mean, that's more like a tactical play. We're bullish on them. So in this, on the previous slide, of course, one of the elements is the AI-led disruption. We are all, nobody has clear answers. How much of that disruption is going to lead to various sectors, but that's a theme we've really called out to say. You saw, I mean, very recently how NVIDIA and the rest of the tech pack sold off in literally 2-3 days. So those are evolving scenarios. We don't know what's the kind of impact it's going to have on allied sectors, etc. AI is of course here to stay, but generally sometimes the risks tend to be overblown. What we've seen, I mean, this was a fear way back in the 2000s as well, when people felt that computers are going to be replacing a lot of human power. What we've finally seen is they've actually aided into the efficiency, etc., and created new avenues of growth. So we don't view it as a fear syndrome just yet, but disruptions can lead to panic situations. So those are the areas to watch out for. Closer home. This is the structural story that we're talking about. And I just want to stay to, I mean, the numbers are clear, but the numbers is a simple story of cause and effect. There is a cause which leads to the effect. So the causes I want to focus on is, I think the big push we're seeing on 3, 4, 5 structural themes and changes. The first big thing Sir spoke about also is the GST collections. I mean, the fact is GST is a destination tax, right? And what it has actually led to, and I'm talking more the point that he said about direct tax collections this time for the first time being higher than indirect tax collections, and the personal versus the corporate also. The fact is that a lot of the people would operate below the radar deliberately and not reported. GST has made it, and we see this by the way as bankers all the time. A mid-sized corporate client would have vendors which are very often vendors which are small scale, let's say 2-3 crore turnover, and would choose to operate below the radar. But in the GST format, you don't really need inspectors, right? If you're a mid-sized promoter and if your vendor needs to deal with you, he needs to have a GST number for the input tax credit story to flow in. So I think the way it's knitted very well is that you are not really creating an inspector Raj, but you as business owners of medium franchises or large franchises are making sure that to get the benefit of GST, all your vendors are GST compliant. Now, that guy who was a small businessman earlier, smaller businessman, not reporting any incomes, not reporting any taxes, etc., his turnover, if he has to deal with you constantly, needs to have a GST number. That gross turnover gets reported, and it's all linked to his personal taxation as well. That has led to a basically clear rationalization of the taxes on both sides. So GST is one big thing. I'm going to breeze through some of the things. Manufacturing, China Plus One, we all know about. PLI schemes, the big focus which has happened. Those are real things. They are here to stay. But in fact, in yesterday's session also it came out. The semiconductor, the opportunity over there is humongous. I want to talk about it a little bit structurally actually. We have been a very sedate manufacturing setup in India for the last close to about 3 odd decades. Barring the 5-6 big names, you can't really think of other big giants who are names, global names in manufacturing. I think that story is changing. What you're trying, I mean, and the bigger piece here is agriculture sector is your primary, secondary is your manufacturing, and tertiary is your services. Because of a weak manufacturing sector, you had a unemployable labor which had to migrate from its skill set from agriculture all the way to services. That was a big step up, which is why you often had a challenge in terms of the quality of employability of people. With the manufacturing sector becoming robust again, you are creating employment at multiple levels, class 1, class 2, class 3, class 4, and those who are doing very well have the ability to skill up and move to services sector and do a better job. So we feel manufacturing is going to be a very big panacea for India. The focus on this is going to structurally make people a lot more employable and upwardly mobile. It is also going to be the biggest delta provider for GDP growth and for the markets for the next 10 years is what we foresee. Quickly on the formalization of the economy, happening through and through. Like I gave you an example of GST, but I mean Jandhan, Aadhaar, and mobile, the linkages have really worked. A classic case here was when Jandhan accounts basically catered to the unbanked. This was not black money. This was not unaccounted money. This was just people who were unbanked. A lot of this money would get pilfered and they basically not have any mechanism to save successfully. But this has found its way into banks. People thought these would be junk accounts, by the way. For the longest first couple of years as the monies took time to build in the accounts. But you know how much that money today is? In those accounts today, that's maybe close to about 3-4 lakh crores, but all the subsidies go into that accounts. Those are continuously getting replenished and actively used. That 3-4 lakh crores is money is lying in the Indian banking system where the cost of funds of this money is 3%, right? If you and I put a deposit, we give deposit to the bank at the highest rate we negotiate for the last 10 bips. Here this money is coming to you, large corpuses of money getting replenished constantly and are coming at a very low cost of funds, which means it is providing capital, growth capital to the banking industry and reducing the overall cost of funds. Does it, from a capitalist standpoint, it helps the industrial economy of India. All the borrowers are able to then borrow cheap because the cost of funds, which is why you've seen in India the mortgages rates, the corporate borrowing rates are all now reasonably very well priced versus the deposit rates. The delta is, I mean, the differential between a lending and a borrowing rate today is only about 150, 200 bips. It is a very healthy margin, right? So I think that's the one big piece we're seeing as consequence of formalization, which is helping the broader economy in terms of the reduced cost of funds. Startup ecosystem. Yesterday we were speaking to somebody, and by the way, I mean, people in Dubai overly invested in India and majorly seeking pre-IPO, unlisted, etc. That's the reality. And I want to step back and talk about this here. There was a time when NRIs, etc., would look at India, sending money to India as a sustenance money, right? Basically, you would say, okay, I've got an extended family, I'll just maintain them and send some money. That was the story of remittances. That's not the story anymore. If you are seeking growth, if you are seeking capital expansion, India is the market. Today, we are seeing monies, capital expenditure money, your own money, which is your growth capital, is finding its way into India. It could be unlisted, it could be stock markets, it could be plethora of things on real estate, etc. 20% of high-end real estate gets lapped up by NRIs in no time, right? 20%, that's a very, very high number. So the whole story is India is now a destination not just for resident Indians but also for the international Indian diaspora outside, actively so, not just for very openly listed products or a very, very limited set of inventory, but they're getting deep into unlisted angel investing forums. NRIs are dominating, right? So that's the scope of opportunity in India. Obviously, you've got about 150 unicorns, fastest pace of growth. But what has been now this is where you need to take a step back. I'll just take 2-3 minutes and close this. Take a step back and say, what is causing this tech stack to do very well? Who formed this? There was a time when people would say, there were banks who would publish, we open a branch a day. That is passé now. If you make a statement like that, you probably will not be rewarded for it. Why? Fintechs have come, set up their shops without a branch and are able to reach the unbanked last mile connectivity rather easily. Why would you need so many branches then? Which is the whole thing. Who owns that infrastructure? The government of India. The entire digital stack, whether it's the UPI or the Aadhaar authentication verification, you are able to run entire businesses as long as you've got a product suite which can go to the last mile. You can fulfill those requirements of opening an account, do a credit card, do a personal loan, any of those stuff without a physical branch. That's a digital infrastructure created by Government of India, built, and now it is a formidable story. So I think those are the stuff which are basically feeders. Now, Startup India, when it started 10 years back, looked like a joke. Today, our cards, which have been, I mean, normally we would feel salaried people, top banks, etc., would carry huge card value. It's the fastest pace of diminishing we are seeing here, because today it's very fashionable, very in the limelight to say I run a startup business, because the biggest delta for growth, as long as you've got a compelling story, you will find capital. It's that compelling, right? The entire new gen, if you go to any of the IITs, by the way, or top schools, 30-40% of the people who would earlier be entrepreneurs used to be generally the backbenchers or the ones who wouldn't get a job. It's absolutely the reverse now. The top creme de la creme chooses universities overseas based on the best entrepreneurship labs that they have. So that's the pace of change. I think a lot of it in the change which is happening in India is a public infrastructure which has been created, and that's a big win. Lastly, this is translated into the numbers that we see: $5 trillion market cap with a $3.754 trillion GDP. Now, basically, your market cap is higher than GDP, meaning India is being quoted at a premium. 5 years back, at a point in time during COVID, we were about $2.3 trillion GDP, market cap had come down to 1.5. 56% was the market cap to GDP ratio at the peak of COVID, because nobody wanted to buy the market thinking India would not be able to come out of the COVID story. You are exactly reverse. US and developed markets which have a growth story runway very long, the key ones, trade at close to about 140, 150, we are at around 120 market cap to GDP. One can say that we are overvalued right now. That could be fair, but the beauty of India is it never sells so cheap, and the runway is visible, right? So, sorry. I'll breeze through this because we've covered this. This basically talks about the fixed income story. Based on what we spoke about the structural story, how does it lead into the fixed income outcomes that you can seek? We spoke about the rate cuts, 50 bips is what we expect, but like I said, it will be dependent on what the US story plays out. If Fed cuts don't happen, you may not have a very long runway to do rate cuts. But the best part, and I'll borrow some of what Sir also said, the fiscal deficit. Fiscal deficit is needed because it funds you for inflation, it funds you for capex also. But look at the fiscal responsibility and budget management which the India government follows, has been followed closely. Pre-COVID, we were very much on track. During COVID, we went to 9.2%. Double whammy because your earnings also collapsed and your expenditure expanded much faster. You needed to support the social structure, but look at how fast you've come down. This year's budgeted figure 4.9, you're expected to close at 4.8. Next year, you're targeting a much sharper, much lower number of 4.4%, which is at a time when you have actually given a freebie or a bonanza, you can say, of 1 lakh crore tax relief, right? What does it point to? It just points to that while the government is very focused to reduce fiscal deficit, you have to be responsible, you've got to spend within your earnings. They're also focusing on the quality of earnings. So the 1 lakh crore bonanza is of course expected to spur consumption. India has been a consumption-led economy in that sense. And the second big element of this is the capex part is 3.2%. 3.2% used to be a number close to about 1.4, 1.5%, let's say a decade back or 15 years back. 1.5% of a lower size GDP versus 3.2% of a much larger GDP in absolute terms is a multiplier effect we're talking about, right? So great story to look at fixed income. Government of India securities, longer dated paper. If the rate cuts happen, you stand on a very high appreciation opportunity. And lastly, its impact on the equities. I spoke about capex, 3.2%, 6.5% GDP. Don't worry about it. Those are small blips. It is partly induced. 6.5% is a real. Nominal still stands at 10.5%, which means that by the rule of 72, you will be closer to doubling yourself in 6 years' time. On a high base, that's a great story. But more importantly, the 6.5%, the slowdown that you saw, largely if you break down why the GDP for last 6 months has been slower is on 2 counts. One, the public capex was lower, 46% of the budgeted money was spent till November, December because it was an election year. It always happens in election year, right? Model code of conduct, you can't act, and then it takes time to reform, etc. So it's a very normal thing. By March this year, we still expect that a lot of these allocations will find its way into firm allocations done. So, but the biggest runway of growth you will see this year. Second part of it was also about a conscious decision by the RBI to reduce fluff in the market. So, they nudged to be cautious about the MFIs, the unsecured lending, etc., which led to a reduced consumption story. But it's not at all we don't see it as a gloom story at all. We see these as course corrections, which are very normal. It is good when corrections happen. We get excited when corrections happen because weak hands go out of the market, the leveraged positions come off. It's the real solid money which stays. With that, I think I've taken a lot of time. The slides are there. Nothing that I need to call out separately. Thank you so much.
Thank you so much for a very insightful presentation. I know that we are all a little bit tight run now. We were supposed to close by 11, but I'm sure another 15-20 minutes you all can spare, I guess, right? So we will have a question and answer session. We will have Lakshman. I just want to say this, Mr. TP Oswal can also join here. Please stay beyond stage, please. This event is ably supported by Institute of Company Secretaries in the UAE. This session is going to be moderated. We've got a short panel session moderated by Lakshman. I'm sure everybody knows Lakshman. Lakshman is a chartered accountant, seasoned professional for the last 30 plus years, worked in different parts of the GCC, whatnot. I can only just say, you scroll on LinkedIn, you will find him in at least on every half an hour, 1 hour time. That's all omnipresent everywhere. So such a seasoned professional, Lakshman, and yes, I think around 20 of his members or 15 of his members have also joined today for the session. I would like to welcome all the company secretary members who have joined here today as well. So over to you, Lakshman, please.
It's a pleasure and honor to host TP Oswalji and Nikhil from HSBC. In the interest of time, I know all of you have a lot of questions. I will ask a couple of questions and then leave the floor open for the questions. My first question to Oswalji, 12 lakhs rupees, no income tax, masterstroke. No other country in the world has done it. But why now? It could have been done immediately after COVID. Is the government seeing anything? Now the consumption, the GDP is a bit slowed down over the last quarter or so. Is the government seeing something? And they made these changes. Why do you see this?
Everybody looks these amendments from their own perspective. Tomorrow's newspaper will flash that this change was made with a view to see that election in Delhi is won. This is exactly I am saying. Because of that, and because of that, Delhi is one small city, and this budget is for the whole country. What you ask the question is very relevant. Why so late? Better than never. Late is better than never. So therefore, this government has realized in last 3 years, look at our tax collection, personal income tax collections going up. Government revised the estimate this year twice. Still it is going up beyond that. So therefore, the government got a confidence. And therefore, they felt that it is possible to take steps in such a manner that you release little more money to the people and ensure that they consume that money. And if there is a genuinely expenditure on consumption, impact of the economy will be 5 times. And therefore, it will benefit to us.
So the follow-on question, Oswalji, is, if there is such a small number of taxpayers, and this question came from our member Naveen Kapoor, 1 lakh or so taxpayers, in the country, why do you need to have this
Income tax act itself. Even I
Can you scrap it?
Even I feel so. Why should we have income tax act and waste so much energies on the taxpayer? Which income tax act in India people think that they can terrorize people by searching the taxpayers and collecting more, which is not the case. When the search takes place, intermediaries make more money than the government department. And the tax collection should go down. Income Tax Act should be abolished. Honestly speaking, should be abolished. This has been in demand. They could increase the banking transaction tax. They could increase little GST. The GST collection is going up, and everybody who is not part of GST now started coming into GST. Collection is going up because of that. If you are reporting GST, it means your income is more. It means then you have to pay the tax. That is why the tax collection is going up. And the government has taken very proper, balanced view on the subject. Number of countries have tax exemption limit much higher than ours. But we jumped it now to this level.
Thank you. This question is to Nikhil. If you pass the mic to Nikhil. Sorry. If the stock market was a barometer of our economy, the market did not move much. If you look at the last 3 days of data, where do you see the market sitting? You made a nice presentation of the global story, particularly the US and the India story. Is the stock market giving a thumbs up to the budget? Or what is your view?
Okay, so I think these are only very, and I again say this, I use the word noise. These are always very, very transient sort of statements. Principally, everybody's view is very clear. You are a consumption-led economy, and you need to also have capex in infrastructure, etc., to spur long-term growth. Right? Consumption gives you short-term continuous kickers to sustain, and you are a consumption-led economy, like you said. The second bit, like I said, capex has a multiplier effect over a 5-7 year cycle. Have we reduced on capex? The answer is no. Have we reduced on consumption expenditure opportunity? I think we've increased that multiplier. Beyond that, stock market is a function of liquidity. Now, what is happening today is, in the short term, these liquidity events can be favorable or adverse. So there are times when there is no good news or structurally solid news and you could be rallying, I would be worried. If, however, the story is that structurally you look very well placed, you're investing in the core story, even if your so-called results of instant gains don't come through, it's brilliant. It allows you to invest more, it allows you to think through and choose your sectors, because you want to maintain sustainable growth. To our minds, I think, like I said, the hot money today is fine moving out. It's the ETF money, but it comes back equally fast. So it could really surprise you in the upside in 15 days for all you know. But structurally, we feel nothing has been done which is to dent the overall broad-based tax collection story, the capex story, the consumption story, etc. What you may see is, I think, little bit of a change of capex mix we've seen, moving from roads and ports, etc., which is always there, to also catering to urban infrastructure. So some of the tweaks, but all of which it will be helpful.
A question for both of you. When you look at GDP, we're talking, growth rate. We compare with China. Some say we shouldn't compare with China, we're a different country. But certainly some parameters one needs to compare. If you look at the exchange rate of China over probably 20-30 years of history vis-a-vis the Indian currency, and obviously you had some slides, Nikhil, about the rupee now probably touching 87 or a little more than that. As an NRI, yes, when we are remitting money, we're getting more Indian rupees into the country. But when you look at, banking here for investments and saying India has a great story, invest into India, and obviously one of the key questions which does come is, I put it in dollars, in this country, for example, UAE, or rather the GCC countries, pegged to the dollar, you're putting it in dollars, then obviously the depreciation perhaps per annum 3% or whatever that number is. And then the comparison with China come in. So how does this all stack up? We are heading now to a 5 trillion economy. This budget presumably will probably push us maybe faster, or maybe, as Ostwalji says, maybe a bit year later, depending on how our consumption is going to play. How do you see this as a banker, and how do you see this as a practicing chartered accountant?
After you say. Acha. No, so first of all, if I read it, you're saying versus China, and secondly about versus dollar and rupee, how to sort of go for it. See, the dollar rupee is very simple. You choose your vehicle. The GIFT City is a classic case which has been created now to say that it's the NRI's offshore center which is created. Today you can do dollar, pound, euro holdings there and still take India exposure, retaining your currency flavor, right? So eventually, I mean, this is just something which is kicking off now, but in the next 1 year or so, for instance, you will have all kinds of AIFs, PMSs, etc. being there in GIFT City, where you can retain your dollars as is and still have a market exposure to not just India, to other markets also. See, what I spoke about here is choose your markets first. Where do you see capital eventually moving? And then your battle. So I'm not saying go for India only. I'm just saying today it looks like a compelling story, but so is US. I mean, we just spoke, US is a 15% growth rate, it will dominate. But which is the allied country which is expected to get disproportionate benefit is India right now. That's the other part. China versus India element, I think they have already had a very, very stellar growth. I don't, by the way, think we are in absolutely comparable terms in terms of the size of the economy and their efficiencies which are already built in. Having said which, when I said the whole preference, see, because stock markets are always forward-looking. And forward-looking view is about what is the potential upside over the next 10, 15, 20, 30 years that you see as a trajectory. That is reflected in my mind in the market cap to GDP ratio. They are not at a premium. India is being given a premium because there is an expectation of demographic dividend, the consumption story. Their population is now fast aging. I mean, their one-child policy, all of that. Now, it's a combination of various factors, but the market doesn't afford a premium to them right now versus what it's giving to India. Fact is, we have a room full of people at 9 a.m. in the morning on a Saturday. This is only possible in Indian communities. Otherwise, people would be preferring to play golf on a Saturday morning. So Indians are hardworking by nature everywhere, right? And I know quite a few people were there till late night yesterday evening on a forum. Now, it's not like they don't know, but it's also because everybody wants to come and network and grow collectively, right? Everybody, when you all are running businesses, you all know some of these nuances very well, but people come, take out their personal time. The growth ambition in general for Indians is way higher than any others that I foresee. And it's a collective which really pulls the community higher up, right? So those are some of the things, but a little bit of economic element, but a lot of it is the whole demographic way of how Indians work. Yeah.
Thank you, Nikhil. Ostwalji?
Nikhil said, beyond that also something else, 1+ China policy is not only for Americans. We see this happening with Germans, Japanese as well. Some of the countries have focused attention on India, and that is, reasons are very simple. Our population, young population is below 35 is 48%, and reverse is exactly China, is aging population. One-child policy is now killing them. So because of that, the future lies in the young people. World requires younger people. After India, you have now in Dubai, I am told, after Indians, now Philippines are taking over. I don't know to what extent is correct or not, but that's reality. And they are English speaking folks and they are younger like us, hardworking. So whichever is the country which has a hardworking population, intelligent, Indians are another advantage is Indian intelligent also. They don't just, Chinese believe in mechanical work very smartly, they do it. Same thing, you have to pick up here and put it here, pick up here, put it here, pick up, put it, no problem. But Indians think, why should I do something different? Let me give a simple example. Though 1 second more. There was a Japanese company manufacturing medicines, packing in a packed product. And some of the complaint came that some pockets were empty. So they conducted a study engaging top consultants in the world how to solve this problem. Lot of suggestions came in. One Indian fellow was working there. He says, what is there to work about? It can easily be solved. Why do you need so many consultants? He says, put a fan over here and see if the box is empty, it will fly. Rest all boxes will go. This is out-of-box thinking which is possible. And India-China story, as rightly Nikhil said, the world's attention is on India. And the world attention on China is sanctions. And this story will change the whole perception.
Thank you. One last question from my side before I open. Everybody has a wish list when it comes to budget, because crores of people are watching it. I had certain wish lists. I'm sure I had certain wish list as an NRI. I'm sure you had certain wish lists. Did your wish list come to the budget?
My wish is if the tax goes away is the best. It will not go. Those who are paying high taxes will continue to pay the taxes. It is not easy for the government because then there is a political repercussion on that. People will say, oh, you are rich people's government. So therefore it will continue.
If the tax goes away, I think our profession is in trouble as well to some extent.
Beg your pardon?
Our profession is also in trouble to some extent.
I think our profession is not in trouble because they are not gainfully employed somewhere. They are doing useless work.
Nikhil, you have a comment?
Well, no, I mean, we don't make wish lists at all. We react to how the budget was. To be honest, I mean, I think we've seen a trajectory of growth. If it continues to get fueled, see, it's not right to have a wish list when you don't have a full view, right? We can be all very selfish in our vested interest to say, ye hona chahiye, wo nahi chahiye, and all. But I don't have a full view. So unless you have a full view to say how do you balance out tax collections versus tax expenditures. I mean, everybody wants to comment on CAPEX, but where will you get CAPEX if your OPEX itself is dominating? So I have no, I mean, obviously we are fairly I would say we're in a fairly happy place. We've seen a trajectory of growth and we feel this trajectory of growth looks very sustainable. So yeah, that's.
Thank you, Nikhil.
And taxes are getting rationalized. So, I mean, the one big thing we always felt was you need a widened tax base. I think we're moving in that direction. Because I definitely feel that, everybody needs to have a skin in the game, right? You cannot work on a very narrow tax base. To be honest, while there is a view that direct tax collections should be ideal, I feel indirect tax collections actually have a good role to play, like yes, sir also said in his speech, because in a way, you don't get away with nothing. So indirect tax collections and agriculture, for instance, a lot of the very large players of agriculture also end up paying no tax on agricultural income. At least their big gas guzzlers compensate somewhere from those, because I mean that's the reality. So at least through diesel, all those petro taxations, etc., at least some tax is recovered. So I feel indirect taxation has a reasonable role to play then.
Thank you both. With that, I open for the floor. Keep your questions brief. Here we go.
Insightful discussions. My question is not on the budget, but more on the human interest angle. This, I think, is our finance minister's 7th or 8th budget, Nirmala Sitharaman's. As a woman, I'm biased, but she's had a lot of bad press. So I don't know whom to believe, what the media says, but how will both of you can answer this? How will she go down in the history books? Is she an effective finance minister like Dr. Manmohan Singh? What would history, how would history treat her?
You are talking about the perception of the finance minister.
Yes.
Well, everybody knows she was a spokesperson. She is an economist. She worked with some time in PwC. And honestly speaking, she understands economics like Manmohan Singh, but she is not a visionary. She is driving the business through somebody else's mind. We were calling Sonia Gandhi as de facto Prime Minister, despite the fact Manmohan Singh was a Prime Minister.
History has been kind to him. I mean, when you look at history books now, everybody talks about.
No, it is all approved by Prime Minister.
Nikhil, any?
I'm sorry, I will not be in a position to comment on.
Thank you.
Question at the back, the two questions.
Good morning, everyone. This question is, if anybody can answer in the panel. This is about the India growth story. Everybody knows we don't need to talk about, but there is definitely a vision the government is looking at the Viksit Bharat by 2047. My question to each of the panel, I think they represent different sections of the society in terms of banking, accounting and professional, and of course IBPC, representing Mr. Lakshmanan as well. So how the kind of vision which the Modi has laid out, this cannot be realized without a PPP approach, which is the public-private partnership approach. So how each of those organizations, like you represent a bank and you represent a CA firm, and Mr. Lakshmanan representing IBPC, so what each of us can do to really help realize this vision? And especially one more question was in terms of we feel that there is a 5 to 6% growth is a standard what India will achieve to achieve a Viksit Bharat by 2047 or even a couple of years earlier. Where will the extra delta growth will come from? That's my question really.
See, as far as your first question is concerned, as a private citizen and professionals, how we can play our role. Our role is very simple, that we must communicate to the taxpayers or the world that be honest and comply the law. And we should not encourage, we should not be encouraging non-compliance. Very, very important. And for that, code of conduct is very essential. I said to you earlier in the first part, in the last question, if searches takes place in India, the beneficiaries are always intermediaries and not the government. The statistics shows after the search, 94% of the cases government lose and till the Supreme Court, and only 6% small cases government succeeds. So therefore, government should do away with the litigation. The government is the biggest litigator. Every single case, now they have increased the financial limits, but every single case they want to pursue till Supreme Court. And as if Supreme Court is the final authority to decide. For example, take the case of Brazil. If the tribunal decides the matter against the government, this is final. They accept unless a question of very, very serious question of law is involved, where the minister decides to go further. So therefore, we have to change the psyche of the people and administration. Accountability to the administration should be brought in, and that is not getting into the country. Whatever the direct tax code, whether you get 1, 2 or 3 as the case may be, if you bring accountability of the tax officer, if you have done something wrong and you are found to be doing wrong by the courts later on, you should be held personally responsible, which is not happening. And that is what my vision is. Possibly, if you can achieve that, India can flourish. Now look at that is happening little bit. For example, faceless assessment. India has now introduced concept of faceless assessment, faceless appeals. You file your return will be looked into and processed behind the computer by the team working on it, and you get a result on your portal. There is a hearing, etc. They give everything faceless. But so-called faceless is one-way faceless. You know that you don't know who is the commissioner, but he knows who is the taxpayer. That is the problem. And then he approaches through the agent, the taxpayer and or his consultant. And this was brought to the attention of the government. And the government yesterday, if I am not mistaken, yes, yesterday came out with a statement that we are now aware and we are taking remedial steps on that. They caught hold of 5 chartered accountants, 2 officers involved into matter, and they blacklisted them, they arrested them. So something is happening. It's not that something overnight. In a big country, we have a federal system. Everything is centralized in Delhi. So to percolate this system to field level takes some time. And I am quite hopeful that this is going to happen in my lifetime itself.
Yeah. So you spoke about Viksit Bharat and the vision around it. I think one of the big factors, while a lot of actions are being taken, one of the big measures of whether you're headed in that direction is uh, the uh, the per capita income needs to jump up very sharply. Now that's easier said than done because the skew on the, I mean, your GDP is going to rise, your population, let's say, even if it starts to flatten out eventually, the difference between the haves and the have-nots is extremely, extremely high. And the have-nots, a big part of it is below the threshold of I mean, borderline, I mean, developing country threshold, etc. Now, if you have to be a Viksit Bharat, you need to really move a lot of this gentry way higher up. Meaning, while your overall numbers still go up, GDP will be high, no doubt, but you still have to have a lot of people earning much higher than what they're doing now. Very difficult because this involves a very vast skill development, employability at a very larger scale, which is where I said that a lot of the and standard of living, ways of thinking, all of it needs to mature, which is why your missions like Housing for All, I mean, all of these are adding bit by bit to make sure that the quality of life goes up. A big part of the budget allocation this time is around skill development. Now, for 1 year budget, it's not going to happen. But the intent really is that as you develop manufacturing ecosystem through a China Plus One, PLI, etc., a class 3, a class 4 person, a person with extended families in agriculture, some of whom will move into manufacturing, will become a lot more employable, and then they can do their skill development but ramp up their earnings. So it's a long journey, which is why 2047, because by the way, by the pure maths, in 5 years, you will be the 3rd largest economy, bordering around $10 trillion. But that's not Viksit Bharat. Viksit Bharat has elements around how the quality of life of an average person ramps up sharply. And average, like I said, per capita income, most people should be very, very high. A lot of, so I think that's where we are headed. It's not going to be easy because, like Sir said, very vast spread out country, 70% of the population is in villages, lifestyles can be dramatically different. I mean, basic amenities like electricity, food, I mean, food and water was still there, but electricity, a lot of these things, roads and all have come in now. But housing for all, slums redevelopment, etc., lots more to be done. But I think there is capital available for it. I mean, a classic case I say is the FASTags, for instance, right? It may seem very benign. We had budgets, and if you go back to 2012, 2013, big issues around most of the projects were stuck up because the way projects used to make money is through cost overruns, but land was not acquired, etc. That was the ecosystem. But as the model changed and you said you need to have full land acquisition first before the project can be done, but then how do you make the project marketable? Because आप वो 3-4 साल के बाद टोल बंद कर देते थे because वहाँ पे भीड़ लग जाती थी. Toll collection was all, आज 20 rupees toll है, कल बढ़ाओगे 22 you make it. 2 rupees change, who's going to have? And population is huge, so tolls were becoming unviable. What FASTag did was it was sold as an efficiency model, etc., but it allowed you to debit monies instantly. But the beauty of it is today, if the toll was 20 rupees, it became 23, it became 26.5, 15% growth every year in rupee terms. You didn't even realize. There were no queues, so it solved for an issue. But more importantly, what it then led to is those toll projects, stretches of 100 kilometers, 50 kilometers, growing revenues at 15% every year, became viable for a Canadian pension fund, the Abu Dhabi investment authorities, the equivalents of sovereign funds, because even if they did a hedging cost at, let's say, 6-7%, you're looking at a dollar return of 8-9%. and a pension fund which was targeting long-term assets of 2-3%, getting 8-9%, good quality, reasonable cash flows. So that's what FASTag did to you, and it is doing that to you. Now, obviously, the Dubai model is really fancy. I mean, we see that without that tag as well, but we're going to be there.
and the prognosis for the country as a whole. Brilliant. Thank you, sir. And may God give you long life. You did allude to it. Abolishing income tax, I must say, the thought crossed my mind. Abolishing income tax is probably the quickest way to turn India into a Dubai. There were plenty of things, but I have to hold to my promise. I must say, one huge takeaway from today's your lecture, sir, is the distinction you made between the taxpayer and the tax filer. It's very obvious when you say it, but until you said it, it wasn't very obvious. We categorized everybody as a taxpayer, but that distinction is very important. I can go on, I swear, I can make it longer than his speech itself, keep it short in the interest of the fact that there's another meeting scheduled. We're due to have started some 14 minutes ago. It's a board meeting, committee meeting by IBPC. And as to Nikhil, you blended the world of investments with the common man's street life, taking it right down to the fast tag. Yeah, again, very nicely intertwined. Thank you. You had to stay true to your job at HSBC, and you had to stay true to your nationalist fervor, and you blended them both very, very nicely. Yeah. As to others that I have to thank you to Lakshmanan and ICSI for doing a joint meeting. Somewhere in our year's agenda or in our board's strategy is the combining of efforts of various entities and for IBPC to blend in with the organizations around. And so your initiative is laudable. Yeah. Thank you to our AAA group, focus group, James Matthew, the convener, and Lakshman again, as co-convener. We were thanking you too much, Lakshman, actually, but it's all deserved. Yeah, as well as to our office team led by Amitabh Banerjee, General Manager, Ravi Iyer, and our newbie, Shagufta Parveen, who's just joined us this week. She just got hired as admin manager at IBPC, and I can see she's hit the ground running. Thank you to Taj JLT. This is our first outing with you, and I hope all of you had a chance to take part in the breakfast that was on offer. It's a couple of Salik tags for us, but it's okay. We'll take it. Yeah. And before I close, thank you to all of you audience, as Nikhil rightly said, to come on a Saturday morning and to hear about the intricacies and all the statistics and all the clause numbers of the Indian Income Tax Act is not everybody's cup of tea, but you braved it. Thank you all, and look forward to more such sessions. The session started on time, and all for a good cause. We ended a little late. Thank you all. Bye-bye.
much.